So what if I told you that the single most important book on investing wasn't written during some roaring bull market, but was actually forged in the fires of the worst financial crash in history? Well, today we're unpacking Security Analysis by Benjamin Graham and David Dodd, the book that really gave birth to the whole philosophy of value investing. Okay, to really get this book, you first have to picture the world it was born into. We're talking the early 1930s, a time of just absolute financial devastation. The Roaring Twenties had ended in this spectacular collapse, and all the old rules of investing, they were completely shattered. I mean, the sheer scale of the wipeout is just staggering. An 80% drop? Think about that. This wasn't just a correction. This was a complete annihilation of wealth that basically vaporized the speculative, trend-following mindset that had been so popular just a few years before. And this quote right here, it just perfectly captures the mood. People genuinely believed the system was permanently broken. So you see, Graham and Dodd weren't writing some abstract academic theory from an ivory tower. They were creating a practical, real-world survival guide for a world gripped by fear and loss. So out of all this chaos, they introduced a single, powerful idea to try and restore some order. They drew a really hard line in the sand, creating a crystal clear distinction between two very, very different activities: investing and speculating. And let me tell you, this definition was absolutely revolutionary. An investment had to meet these three strict criteria. It required deep research, its number one priority had to be not losing money, and it needed to offer an adequate reward. And get this, anything that didn't meet that standard was simply speculation. Period. You see how this just created a massive shift in mindset, right? You stop trying to predict which way the market winds are going to blow, and instead you start acting like a business owner, analyzing the fundamentals of the company you're actually buying. It's a huge move from forecasting to analysis. Okay, so that's the core philosophy, but, how do you actually put it into practice? Well, Graham and Dodd built a practical methodology built on three powerful, interconnected pillars. Let's take a look at how they all work together.
These three ideas, they're not separate things. They form a complete system. First, you figure out what something is truly worth. Second, you buy it for less than that to protect yourself. And third, you use the market's crazy mood swings to your advantage. Let's break each one down.
All right, first up, intrinsic value. You got to think of this as the bedrock of the whole thing. It's the value of a business based on its real-world stuff, its assets, its earnings, its dividends. The whole point is to figure out this number, which is totally separate from the often crazy price tag that's flashing on a screen every day. Next up is maybe the most important concept for managing risk: the margin of safety. Look, since your calculation of intrinsic value is always just an estimate, this is your cushion. It's the discount you demand to protect your money from errors in your own judgment, or, just plain bad luck. And nobody explained this better than Warren Buffett, Graham's most famous student, with this perfect analogy. The margin of safety isn't about cutting it close. Not at all. It's about building in this enormous buffer so that even if things go wrong, you're still safe. And finally, how do you get that margin of safety in the first place? Well, you get it through Graham's most famous creation, the allegory of Mr. Market. He wants you to imagine the market as this manic depressive business partner who shows up every single day offering to buy your shares or sell you his at these wild prices based on whatever mood he's in. The lesson here is so simple, but it's incredibly profound. You don't take your cues from Mr. Market's emotional state. You use it. When he's terrified and offering you shares for pennies on the dollar, you buy. When he's deliriously happy and offering to pay a fortune for them, you sell. He is your servant, not your guide. So when you put all these pillars together, what you end up with is a very distinct worldview. It's not about being the smartest person in the room. It's about having the right mindset, the right temperament. This classic Buffett quote is really the pure distillation of Graham's contrarian philosophy. The entire system is designed to help you act rationally when the rest of the world is just giving in to herd mentality, whether it's panic or euphoria. And this leads to a really deep philosophical split with a lot of modern finance. For a value investor, risk is simple. It's the chance you could permanently lose your money. So a stock that has fallen sharply could actually be less risky now because it has that margin of safety. But for a lot of academic theories, that same falling stock is considered more risky just because its price is more volatile. This table really helps put Graham's whole approach into perspective. While something like modern portfolio theory tries to engineer away risk with statistics, and growth investing is making educated guesses about the distant future, value investing stays firmly rooted in the present, calculating what a business is worth right now and insisting on buying it for less. So, all this brings us to the legacy of security analysis. In a world of high-frequency trading and super complex derivatives, why on earth are we still talking about a book that's almost a century old?
Well, its impact it was just monumental. It literally became the Bible of an entire investment philosophy. It directly mentored some of the most successful investors in history, and it pretty much created the entire profession of the financial analyst by giving them a framework for rigorous, fact-based research. But, at the end of the day, the ultimate takeaway, the real reason this book has endured, isn't about some specific formula. In fact, Graham himself later said the elaborate techniques were less important. The book's most timeless wisdom is about something much more human. It's about our temperament, our discipline, and our emotional control. Which kind of leaves us with a final question for the world we live in today. In an age of algorithms, AI, and a 24/7 news cycle designed to provoke fear and greed, is it possible that the greatest advantage an investor has isn't a faster computer, but simply the old-fashioned ability to stay calm and rational?